Let's get into it. I was just having a quick look at the time. I got time.
One of the most trickiest and difficult questions to get to grip with when you start investing as a new investor is whether you should buy individual stocks or invest in an index fund. Now, this was a problem I first encountered thinking I was a smarty pants and picked individual stocks. I realized quite quickly and without too much damage that simplicity is often the best. So investing is not supposed to be difficult, and investing can be made more complicated than it needs to be actually. So last year, and of course hindsight being involved, with buying FANG stocks was massively appealing to me, and those are the Facebook, Amazon, Netflix and Google's. I even did a video on some tech stocks which I thought could perform as well as FANG in my cringe binge days. But in the end, I did decide to put my money into passive tracker funds, and particularly the Nasdaq, which, as we all know, had a phenomenal year, and last year it was up 40%. And so it can be a confusing problem. The problem is in our keenness to invest, combined with the lack of knowledge of the stock market as newbies. We often ignore the best practices, which could lead to issues like concentration risk by having too few holdings, or putting all your eggs in one basket or sector or country, and thereby making the wrong investment calls and making losses. I was just having a quick look at the time. I got time. So this is what also puts investors off the stock market, and instead invest in cash and cash-like products. We have an inherent fear of losing hard-earned cash, and rightly so too, but also we forego one of the biggest wealth generators for our net worth by not considering risk appropriately. In a nutshell though, investing in single companies is more speculative. Also, without access to companies and only being reliant on public information, we don't have all the information other stock pickers have, and so it remains speculative itself. So an institutional buyer or hedge fund would have research analysts at the top investment banks releasing news, have their own resources to research, also have access to potential companies through research and due diligence meetings, which we as mere mortals just don't have. We make sense of numbers, look at pretty graphs, and that type of investing, when you think about it, it's not the risk mitigating approach that we should be taking. So I'm not gonna lie guys, the risk of investing in an index fund is way lower. All you have done is taken on the market risk, and that is the stock market will go up and down, and you have none of your own biases and ideas that have gone into your investments. Key is the longer you invest in index funds, the closer to naught the likelihood is when it comes to losing your initial investment based on historical indices, guys. And that's because the index fund consists of hundreds of companies instead of just one. And so if one company does go bust, it doesn't really matter because the loss is spread over the index and another stock takes its place. If a stock doesn't really do well and it shrinks importance over time, it doesn't matter, it will eventually be removed from the index. So an index is pretty much Darwinian. It's survival of the fittest if you want to be in the top. So while it is wiser and smarter as a newbie from a risk reduction perspective to invest in index funds, that's great. But once you understand the basics, is it still the right way to go? The question is, are index funds safer? There is no doubt that investing in index funds is safer than individual stock picking. Volatile itself, individual companies might go bust, and if you own one of the companies that does end up going bust, your investment is gone. The market is also cyclical, but as investors we like to call it excesses and corrections. It's part and parcel of the market, and as index investors we experience it as an acceptable journey. But as a stock picker, it can be both wonderful or even a disaster. So if you look at major market indices like the S&P 500 and the FTSE 100, when you buy an index fund, we're unlikely to see all companies in the index go bust. If they did, well, the world would be ending, wouldn't it? And most likely during a recession, one or even two may go out of business. Ultimately, you are buying a diversified investment. So one investment spreading your risk over hundreds or thousands of companies, and so you spread your risk as well. Also, while I won't cover it here specifically, you can be rest assured that index funds have generally beaten all other fund types in the long run in terms of total return. So active funds require talent and have higher costs, and both can be damaging to return profile. But to keep it simple, index funds are safer and almost guaranteed to provide you with returns over the long run, but individual stocks offer greater returns always. Yes, correct, while index funds are safer, the returns will match the returns you could gain in a shorter time period of stock picking. Take the community's favorite stock as an example, Tesla, which started at $89 and ended the year at around $700, which is almost 8 times as much. Now, not every company is Tesla, and there are plenty plenty of companies that have not done well last year, but the community got excited about Hertz, though we know how that turned out. If you are savvy, take the time to research, and yes, you can make more money through stock picking if it's something you'd like to get into. So if you're wondering what I do in terms of my investments, well, I do a little bit of both. My long-term investments like pensions and income replacement investments, I invested in long-term investments like index funds and real estate. They make up the bulk of my investments. Then each year I add to my ISA allowance and continue to stock pick with my portfolio. I do have rules which I am quite strict about, which governs how many stocks I'll hold and also how long I'll hold them for and when I can trade them. My objective is to outperform, but I'm not looking to pick the next Tesla either because risk. So a rule of thumb is generally 10% of your portfolio can be a higher risk, which could be in stock picking or other riskier investments. As we like to kiss on this channel, keep it simple, I have a few other videos here which help put meat on the bone for simple investing, including Warren Buffett's golden rule. So you'll find these videos, hope I'm pointing in the right place, and I'll see you over there.